everyone, and welcome to this exclusive webinar organized by Standard Chartered Bank. At the onset, on behalf of the bank, I would like to thank all of you for joining in this webinar, and we look forward towards your active participation over the next 1 hour. Today's webinar's focus is on the Union Budget, which was tabled last Friday. What are the key takeaways that we see in the budget? Which segment of the market is likely to benefit? Is there any sectoral trends that we see? And does it warrant a relook at your investments? We hope to answer these and many other queries in over the next 1 hour. And who better than Mr. Navneet Munnot, who joins us for this webinar. Mr. Navneet Munnot joined SBI Funds Management as the Chief Investment Officer in December 2008. He has over 24 years of rich experience in financial markets. In his current role, he is responsible for over USD 53 billion assets across various asset classes in mutual funds and segregated accounts. In his previous assignment, he was the executive director and head multi-strategy boutique with Morgan Stanley Investment Management. Prior to joining Morgan Stanley, he has also worked as the chief investment officer, fixed income and hybrid funds at Birla Sun Life Mutual Fund. Navneet is the chairman of Indian Association of Investment Professional, Indian Society of CFA Charter Holders with over 2,000 members. He is a postgraduate in accountancy and business statistics and a qualified chartered accountant. He is also a charter holder of CFA Institute and CAI Institute and has also done FRM. Thank you, Navneet, for joining in this webinar, and over to you for a brief introduction to the budget.
Thank you. So I will keep it very brief. So much has already been discussed about the budget and every single thing that has been announced in the budget. There has been huge discussion. In fact, India is the only country in the world where union budget assumes so much of significance. In any other country, large part of the population, even people in the financial markets, may not be aware that a budget got presented today. Because in India, it's not only an account of government's revenue, expenditure, the deficit and the mode of borrowing for the government, but also a platform for laying out the entire social, political, economic agenda. And from that perspective, it was a long speech. The government and the finance minister tried to touch upon various things. The vision for building the country for over the next 5 and 10 years, taking India from the current size of around $2.7, $2.3 trillion economy to a $5 trillion economy, what it needs to be done, which are the sectors that need to be promoted, so on and so forth. If I look at some of the big ideas within the budget, first of all, see the backdrop in which this budget has been presented. So you have, on one side, the growth has slowed down in last few quarters, particularly in last 1 quarter. Even the consumption growth has slowed down. The investment cycle has not been picking up. Our goods exports have been flat for last couple of years, and the government is also constrained because they don't want fiscal deficit to go up. So they can't spend too much of money to prop up growth either on the investment side or on the consumption side, because they have to be wary of the challenges from the borrowing side of the government. Now, given all of these constraints, and look at the global environment where there are issues related to US-China trade war, uncertainty related to US-Iran and its implications on the oil prices, so on and so forth. Given all these constraints, the one good thing that budget has done is ensuring that we remain on the path of fiscal consolidation. Government ensured that our fiscal deficit this year as a percentage of GDP remains at 3.3%. What it does is it opens up an opportunity for the Reserve Bank to cut interest rates. Given the growth inflation dynamics, RBI has the opportunity, RBI has the capacity to cut rates further, to infuse more liquidity further. One can say that government didn't do enough to prop up the consumption in the very near term, but my sense is that I think the focus is that the composition of India's growth needs to change a little bit from here on. Over the last couple of years, investments as a percentage of GDP has come down. We need to start focusing a lot more on the investments, both from the public side as well as on the private side. And maybe, purely a consumption-led growth may not be a good solution for us. And from that perspective, budget stayed away from providing an immediate relief. There were so many industries, whether it's real estate or autos or so many other consumer industries, who were clamoring for for some kind of a fiscal soaps, but government adhere to the fiscal discipline, gave an opportunity to RBI to cut interest rates, which can in turn help both the consumption as well as investment. One of the big idea, if I look at in the budget, is how do we attract more foreign savings. The government of India, along with the state governments, PSUs have a large borrowing needs. Private sector needs to borrow a lot of money. A lot of private sector companies need to sell their assets. I mean, without taking names, I mean, everybody would be aware of how many corporates, either at the holding company level or at the operating company level, need to reduce the leverage, and they are looking at foreign buyers who can buy those assets. And for our investment cycle over the next several years, we need tremendous amount of money from the foreign side. And if you look at several ideas within the budget, right from simplification of KYC for the FIIs to maybe for the NRIs, to opening up FDI, further relaxing the FDI norms further in several sectors, including an insurance broking or media or aviation and variety of other industries, to putting up these large manufacturing parks where foreign money can come, more foreign money that can come in the REITs and InvITs. Variety of things have been done, and the biggest of them all was the announcement of a sovereign bond issue. Government of India has never borrowed in the dollar market or in the foreign currency market. This year, I think the intention is to borrow $10 billion. Why that has been done? Earlier, as I said, that we have a real shortage of savings in the country to meet our investment needs. You need more foreign savings, and the global environment is very conducive. We have almost 12-13 trillion dollars worth of global bonds which are trading at a yield of zero or even at a negative yield. I mean, a German bonds are trading at minus 35 basis point for of a 10-year bond. So in that environment, there is a lot of money Indian economy can attract in various sectors, and that will help us in meeting our investment needs. So that's one of the idea. The second could be simplification on the direct taxation side. So GST, of course, as everyone knows, is completely online. There have been teething trouble, but over the last 2 years, I think we have been progressing well. Over the next several years, if I take the service tax implementation as an analogy, when we started in mid-90s, it took a couple of years for service tax to become even 1% of overall government revenue. But in few years' time, it became 10 and 15% of the overall government revenues. I think something similar will happen in GST. It's too big a reform. It's taking time. But over a period of time, indirect taxes collection in the form of GST will increase. But on the direct taxes side, I think the government has made some beginning in terms of the e-assessment or removing the human intervention between the assessment of IT returns, etc. Again, I think this will be followed by a direct tax code maybe in a year's time. That will also pave the way for, over a period of time, as you simplify more, both on the direct and indirect taxes side, India's tax to GDP ratio can go up, and then government will have more resources at its disposal to invest in physical as well as the social infrastructure. I must mention one thing, that Government of India is one of the smallest government in the world in terms of the amount of money that it spends as a percentage of GDP. Why? Because the resources are very limited. I mean, the tax to GDP is one of the lowest in the world, and government doesn't have enough money to invest in physical infrastructure or the social infrastructure. Through the tax reforms, over a period of time, if we can increase the tax revenue, then government will have more money to invest. Because on the expenditure side, one of our challenges is that if you look at our salaries bill, pension bill, defense, interest expenditure, there is very little money left with the government to spend on anything else. The one area where I believe next few years can make a lot of changes is on the subsidies side. I mean, oil subsidy is a classic example. It used to be till 2013 or so almost 1% of GDP. The peak amount was like some 1 lakh crore plus. This year it is a fraction of that after 6 years. Because I think we liberalize the sector, prices have become market determined, and if there is a subsidy, it goes to the few consumers who really deserve it. I think the same thing needs to be done on the food subsidy, on fertilizer subsidy, on some of the other expenditure. As government spend more money on social security net, over a period of time, some of these subsidy bill can go down, and the benefit should only go to some of the deserving people who are absolutely at the lowest strata of society. One of the big idea of this government in last 5 years, and I think will continue in this 5 year also, is to put a very strong social security or social safety net in India, starting from a free toilet, free LPG cylinder, free LED bulb, a basic electricity connection, a medical insurance, pension for the small business guys, something for a girl child or for senior citizens. All of these form part of a larger, I would say, agenda that we need to provide a very basic social security net, a social safety net for our entire population. And my view is that in this 5 year also, I think the next big target is to have a house for all, is to have a tap water in every house, is to have continuing electricity in every house, some of those things. I think once we have achieved that over the next few years, we would really unleash the power of our demographic dividend, because if 500-600 million people are starved of some of these basic necessities, the country cannot go to the next level. So I think that's good, as long as we are able to implement it nicely, as long as we ensure that there are no leakages in the system. And that's where the importance of the GEM Trinity, Jandan Yojana, Aadhaar and mobile phone mobility, that trinity if we use effectively and provide these benefits directly to the end consumer or to the end population, I think they will go a long way in ensuring a stable or a sustainable, equitable growth for India. So I'll just sum up that given the current constraints, the government has tried its best to ensure that we stay on the path of fiscal consolidation while there are no immediate solutions to the current growth slowdown. But if we retain the macroeconomic stability, if we ensure that financial stability continues, there have been some challenges in the financial sector, particularly the NBFC and HFC side. I think the budget has made some moves to help that sector also. If we do that, ensure interest rates come down, credit growth improves over a period of time, if we take advantage of the structural growth potential of India, I think India should do well. That's my assessment of the budget. I mean, it's very well intentioned, but execution is the key. As I said, it's a 2 hour 15-minute speech where 100 things have been talked about. We'll have to wait and watch how these things get implemented over the next few years. Then we can discuss about implications on the market.
Thank you so much, Navneet. It was a good introduction. But if we've seen in the last few days, the markets have been a little bit more jittery. Is it more budget, or generally the global scenario has turned a bit murkier, weaker, that markets are, or
Yeah.
the valuations? There's a lot of talk that valuations are also extremely rich. So
Absolutely.
there was a want for at least the correction is some sort of a healthy correction.
Yeah. I mean, it's a combination of several things that you talked about, the recent correction that we have seen. My sense is that, I mean, from the budget perspective, the overall market has liked the fiscal discipline. Market has liked that the government's idea is to ensure that this time the growth is led by investment cycle and not consumption alone. They've made efforts to tackle some of the issues which are faced by the NBFC, HFC sector, because that has been one sector which has been facing quite a bit of challenges in last few quarters. But I think few things which have impacted the sentiments negatively. One of them is asking they're asking promoters to increase the public shareholding to 35% from 25%. There are more than 1,100 companies which will have to issue more shares in the public, and that amounts to roughly 4 lakh odd crores at the current market cap. So market is a little concerned that how this supply is likely to get absorbed by the market. I'm sure everybody would have read about it. So that has also impacted the sentiment. Also, as I said, that the growth has slowed down quite severely in last few months, and there are no immediate measures to tackle that growth. So market will start looking at the earnings growth number from this quarter onwards. And of course, I mean, there are some noises around the super rich tax. I think that there is too much of tax on capital in India. I mean, you invest in a company, that company pays almost like close to 1/3 as taxes, and then there is a dividend distribution tax. Even if you do buyback, there is a tax, and then when you get dividend in excess of 10 lakhs, then there is a tax, and even otherwise the individual tax over 20 million and 50 million have gone up quite a bit. So some of these things have not been liked by the market. And also, I think given the uncertainty in the global environment, and of course the particularly the large cap index had run up quite a bit in last few months, so maybe some bit of consolidation was required. My sense is that if I look ahead, talking about these three or four things from a macro perspective, I think the near term remains challenging. For us to get back to a 7% plus growth will take few more quarters, and the market will have to take that into stride. Coming to the corporate profits, over the last 3 or 4 years, I mean, every year we start with an expectation of 20%, we end with a single digit profit growth. In fact, last 2 or 3 quarters, everybody has been expecting a big bump up in the earnings growth, but again, given the recent slowdown, that may get deferred a little bit. The third, valuation. Valuation is a bit tricky to talk about because there is a small part of the market in the large cap space. Even within the large cap, it's few mega cap companies where the valuations are very high, and that's why when you look at Sensex or Nifty relative to their own history of last 10 years or so, they look richly valued almost at 18, 19 times. But the rest of the market has got corrected quite a bit. So I think there the value is emerging. And the last piece to form a view on the market is the liquidity, where I think given the global environment, view has been that more money will come into India, but we'll have to wait and watch. I mean, everybody is expecting that US Fed will cut interest rates. Everybody is expecting European Central Bank will print more money. Emerging markets will get flows, and within that, India will get flows. I think we'll have to wait and watch. There are a lot of other variables. The growth globally has been slowing down. So how the equity flows shape up, we'll have to wait and watch. And domestic flows have slowed down a bit. The heartening feature is that the SIP flows remain very much intact, 8,500 crores, and we also get a lot of money from pension fund. So that's providing a little bit of stability. Now, net, when I add all of these four things, I mean, that's my framework of forming a view on equity market, macro, corporate profitability, valuations, and liquidity. I think for some time we consolidated these levels. Given the structural story and the global liquidity and the global rates, I mean, the huge downside is unlikely. But at the same time, given that where the valuations are and the corporate profit growth trajectory, I think there is no immediate huge upside as well. I think we remain range bound, but structurally over the next 3 or 5 years, I think if the nominal GDP grows at 12-13% and a corporate profits grow slightly higher than that, because last 5-7 years corporate profit growth has been lower than the nominal GDP growth, then I think markets should deliver similar returns. And from investors' perspective, they must keep in mind that a 12% return in equity when inflation was 7 or 8, or when inflation is 3 and 4 are two different things, and one needs to moderate the return expectations in nominal terms given the inflation decline that we have seen in our country.
So, so since we are talking about equity, there are quite a few questions on that. So one is which broadly addressed among all with global issues as well as budget release. What should I do with my existing investments in equity? And he's very the client is asking enter, hold, or exit.
Yes, I think in a staggered manner continue to put money. I mean, if you are already allocated in line with the asset allocation that you would have advised them, I think they should continue. As I mentioned that near term, I expect a range bound market, maybe a small movement on either side, not a significant upside in the near term, but a 3 to 5 year story remains very much intact.
And since you were talking of equities also and you gave the broad framework, how would you place mid and small cap? Because that segment looks has been, if you compare to large cap, there's so much of divergence in performance. So does the valuations warrant that you should start getting into this segment a bit?
Yeah, the valuation differential between large and mid and small cap has widened very significantly. What we have seen since January last year, when the mid and small cap index peaked, we have seen a double-digit return in the large cap, but the mid and small caps have actually gone down. And this is a mirror image of what happened in the 3 or 4 years before that, between 2013 and 2018 or so, early 2018, where mid and small caps substantially outperformed, and the valuations actually went up far in excess of where the large cap valuations were. Currently, I mean, given the overall negativity around the mid and small caps, there is a very limited amount of money from foreigners which is coming. The domestic flows, as we mentioned earlier, have slowed down. The overall the news flow around the lot of corporate governance issues, etc., in last few months, all of these have impacted the sentiments for the mid and small caps. But my sense is, I always believe, structurally, if you are putting money for 5 years or so, the sheer opportunity of bottom-up stock picking in the mid and small cap segment is very high in India. That's where the real research arbitrage is for a fund manager to identify 20, 30 good companies. If you have a time frame of 3, 5 years, has always been attractive. So I would suggest that over the next few months, one should take advantage of this correction in the mid and small cap space, but you need to have a longer term horizon because that will come with higher volatility.
So this is an interesting question. The client has asked, do you expect the following budgets over the next 4 years to be defensive, or they'll become aggressive as they go towards next
So
election?
it depends on what you call as defensive or aggressive, because different part of population. Well, the budget is for 1.3 billion people. It depends on what you call as defensive or aggressive. One might say that I think a lot of these social security that I talked about, I think that's one of the big agenda for the government, and rightly so. I call this India's universal basic income. We have already done in some form. I think that will continue. The government's focus on increasing tax to GDP ratio, that will continue. It will be liked by some people. It will not be liked by some people. Also, the PM mentioned in his first speech that there are two sets of people: one who are poor and second who want to help poor. So those, on the other side, should be prepared to probably shell out a little more than what they have done. And I think the good part in the budget was that I think the focus is on more structural, longer term growth rather than trying to do some short term or solutions or a shortcut to get growth in the next 3 or 6 months. That's why I mentioned that I think the growth slowdown that we have witnessed in last few months, and some of the challenges and some of the sectors that we have seen, will take some more time for them to get fully sorted out, and we go back to the path of 7% plus growth.
So, in the light of the budget as well as what you mentioned, is there any particular sectors you see where there's opportunities over the next, maybe if we take a longer term horizon over the next 3 years to 5 years?
So I think one should more look at the valuations, and I think bottom up stock picking rather than a top down sector call. Having said that, if I look at top down sector within the financials, I think banks are better positioned, or only select NBFCs who have a strong brand and risk management capability and the execution capability, because I think there is a segment within the financials which will continue to face certain issues on the funding side and increased supervision and regulation by the RBI. Banks will clearly be a beneficiary of that because they have a stronger liability side, and asset side growth will continue to increase. We also like industrials because we think that over the last 7 or 8 years, I think we have seen a significant the India's entire growth has come mostly from the consumption side, but I think that has to change from here on. We expect that government's focus on some of the sectors, whether it's the railways or the roads or housing. They've also talked about the water, and maybe over a period of time some of the other segments within the infrastructure, that focus will continue. But on the private capex side, where last 5 years and which has slowed down considerably, is likely to pick up at some point in time as rate cycle turns positive, capacity utilization improves, corporate balance sheets have improved a bit, and banks are in a position to lend for newer projects. Considering all of that, we believe that industrials could be interesting, and then there are various other smaller segments within the market. So the focus should be on bottom-up stock picking.
So, since you asked on bottom up stock picking, there's actually quite an interesting question. With most of the sectors slowing down, like auto sector, real estate, which you mentioned, can we say that bottom is over and now onwards we can look for growth, or you feel bottom is yet to come and will pull down markets?
It's always difficult to predict. I wish I could predict whether the market made a bottom today, or can it bottom in 1 month or so. There are so many uncertainties prevailing even from a global perspective. Nobody really knows the what's likely to happen on the US-China trade war, what's likely to happen on the US-Iran front, which will have its implications on the oil prices, which in turn impacts India's economy, and also the global money. I mean, there's huge amount of excess liquidity. Bonds are trading at below zero. There's a positive aspect and there is a negative aspect. Positive aspect is that India looks attractive. We didn't discuss much about the fixed income because on the bond side, if you look at the global environment, it's very positive for India. So much of money can actually enter the country. But the negative aspect of that is it's actually reflecting the lack of growth drivers everywhere. The global growth is going to slow down. And for us, I mean, last 6 or 7 years, we haven't seen growth in goods exports of India. And even the services exports, I mean, yesterday we saw one of the largest IT company results. I mean, it's showing at least at the margin the growth is moderating. The rate of growth is moderating a little bit. So the global liquidity and global conditions will bring in some positives for India, but there are some other challenges also. So I think next few months, as I mentioned earlier, markets consolidate here. The good part is that in the mid and small cap, the correction has been quite severe, and there are interesting opportunities on that side.
So this is specifically on the NBFC. Since you mentioned this, what's your view on the sector? Do you think the sector is still structurally strong? And what should investors do with that particular sector if they have exposure?
So the sector is structurally strong. Some of the companies may not be, which is true about every sector. So there is a real estate sector, which is structurally a great story for India. But there are several companies which are in deep trouble today. Same thing is about the NBFCs and HFCs, and that's why I mentioned earlier that I think companies that have strong risk management, companies that have strong underwriting standards, companies that are focused on right kind of balance sheet management in terms of whether the way they raise resources or whether the kind of asset liability mismatch, etc. I think all of them will continue to do well. India is still hugely underbanked. India is still I mean, credit as a percentage of GDP is still very small relative to most of our peers or developed countries in the world. We have a long way to go, and there is a lot of opportunities for non-bank participants. Within that, I think what has happened in last few months will actually turn out to be good for the stronger players, and but some of the other players who probably didn't do as well on some of the parameters that I talked about, I think markets will have punished them, and maybe we'll see some consolidation within the sector.
Since you mentioned on asset allocation, so given the risks, what's your view on gold? It's generally considered a safe haven. There's another question related to how should a client look now? Is there also a case where you should keep a bit more cash also in your portfolio so that you can take opportunities?
So first on gold, last few months, in fact, in one of our, we have this multi-asset allocation fund. We increase our allocation to gold because we had a tactical view that if interest rates are going to decline globally, and if the geopolitical risk have increased, whether it's a trade war or whether it's in the Middle East and some of the other issues globally, that could turn out to be good for gold, but that was more like a tactical call. I think from an investor's perspective, because gold is an asset class which doesn't earn anything. I mean, it's kind of a hedge against a lot of uncertainties. There's a big geopolitical risk that materializes, or if let's say globally there is either a severe recession or a huge inflation, both against that. I mean, it's a hedge, maybe a very small part of the portfolio, not too high, because I think in an asset like whether fixed income, I mean, delivers a return every year, and equity has a compounding story over a longer period. Those are earning assets, unlike gold. So maybe purely as a small hedge against those big global uncertainties, one can have a small allocation. And on the other question was on
should you keep more cash?
Should you keep more cash as a tactical? I mean, looking at the global environment, I mean, one can choose between maybe a global or a little bit of cash. But in India, I mean, the good part is that even the cash earns pretty decent returns. So if you're talking about a liquid fund or an arbitrage fund or an ultra short-term fund, the cash itself is earning 6-7% or so. My sense is that if you are a long-term investor, then trying to time the market, having these cash calls are easier said than done. I mean, I remember post demonetization, a lot of people, a lot of our clients and advisors used to ask that given that demon and then we'll have the GST implementation and then we'll run into the election cycle, etc., growth is likely to go down and then I think markets may not do well. But it turned out to be a great year, 2017, both for large cap, small cap, mid caps, everything, and people missed out on that. And at the beginning of last year, when mid and small caps were at peak, those investors ended up investing at a wrong time. So, I mean, trying to time the market is a bit risky. I would say, I mean, adhere to the asset allocation and remain disciplined.
Since we're talking of asset allocation, would like your views on fixed income. Is it a good time because yields have really corrected? The bond market has reacted so positively to the budget and
Yeah.
even other factors. Global yields have also fallen.
Yes.
So is it a time where fixed income could, if we look at just the composite index or whichever you get a bond, it's actually given better returns than equity over the last 1 year.
No, very clearly, as you rightly mentioned, that the bond markets have reacted positively. The government bond yields from a peak of like 8.2 or so in September last year. Now we are at close to 660, 670. But spreads have not come down as much. I think whether it's even at, actually there are so many AAAs now because one AAA versus another AAA, the spread itself is could be very high. There are opportunities in the other segments of fixed income market also. In fact, I would argue that even in credit risk fund where spreads have widened very significantly because of the events that have unfolded since September last year, the spreads are now very attractive on a risk adjusted basis. Even the credit funds, credit risk fund also look attractive. The overall fixed income as an asset class, given where the growth inflation dynamics are, given the demand supply dynamics, and I'm looking at the demand coming in from foreign investors, I think if I put it all together, fixed income looks attractive across segments. Yeah.
So
Depending on one's risk appetite and time horizon and liquidity needs, one can allocate within that.
So from the budget perspective, do you think the government has done enough to attract investment, especially FDI from abroad?
So, I mean, there is so much to do in India. I mean, as the government said that we are at 2.7, $2.8 trillion economy, currently growing less than 7%, but the aspiration is to grow at 8%. And few years back, we used to talk about 9 and 10%. So, whatever you do, there is always a lot more to do. And that's why I mentioned that budget was very well intentioned. There have been lots of things that have been talked about because we talked about the investments and infrastructure. So that they talked about a power grid, a gas grid, a water grid, PPP in railways, affordable housing, rural roads, more airports. I mean, a variety of things have been talked about. I think execution is the key over the next several quarters. I mean, the finance minister can only do one bit. I mean, lots of other ministries and along with the state governments, a lot of role is played by the state governments in India. And one thing I would add here is that GST Council has showed a way in India how state and center can work together. And my view is that what we have done in GST, which is probably the most difficult thing to do for like all the states to sit together on one table and decide things with 100% consensus. Can we not do the same for land? Can we not do the same for labor? Can we not do the same for power? And for some of the other things, I think over the next few years, there is a way that has been shown by the GST Council. And I think if we do that efficiently, then I'm sure a lot of our current issues may get addressed.
Also, since we're talking of the budget itself, is there anything done by the government which could help the small scale industries? Is there simplification of GST, something which has been announced?
So I think they've talked about simplification of GST and also I think the simplification of the IT returns, that the e-assessment, etc., and you can use only an Aadhaar number. I guess over the next few years, one of the idea of the government is to focus more and more on ease of doing business. So when you say that you don't have to put your PAN number, because you can just put your Aadhaar number, I guess for lots of other government dealings, If one can just put one single number and every department you go and you have to submit 10 documents, which is already there in the government domain, as more and more things get linked with the Aadhaar, it can pave the way for an easier, dealing with the government. On the other side, I think the credit availability has been bit of a challenge, particularly because of the issues pertaining to NBFC and HFC sector, because they were a big provider of finance to SME, MSME. I think some of the moves that the government has announced for increasing availability of finance to that sector, I think that will help. Also, I think government payments to some of these entities, there are some steps in that direction. How can that improve? And of course, in last 2 or 3 years is the SME, MSME segment, because of maybe the flat exports growth, maybe because of the demonetization, GST implementation, RERA implementation, a lot of these reforms that came in a short period of time, and the growth has come off. So SME and MSME sector has faced huge amount of challenges. I think there is a recognition of that, and some of the steps have been taken, and let's see how they get executed.
Also, the government announced further reduction of corporate tax 25,000. They increased the threshold
To 400 crore, up to
Are there
400 crore of
companies in the listed universe which would qualify?
Not much in listed, and even if there is a company, let's say with a 300-400 crore revenue, but when you are buying stock, you are expecting them to grow and become big, and then suddenly from 1 year, from 25, you go to a substantially higher rate. And for institutional investors like us, I mean, that's not the segment that we really look at. But yeah, maybe there could be some of the micro cap companies. Yeah, one can look at.
So this question is from one of the clients who's asking, what's the budget interesting for middle class consumer? I think people have forgotten that in the interim budget there was already a sort of a tax,
some sort of
tax
relief that came to the middle class. Yeah. So I think some of the people in the middle class have not liked the increase in the petrol and diesel prices. That's kind of a direct money that is paid. As long as that is utilized well for infrastructure development, if it leads to more road construction, or if it leads to better or more ease of living because government is improving infrastructure, it could ultimately turn out to be good. But as I mentioned earlier, that there are very limited resources, and you have a large part of the government spending which is quite fixed in nature. So there is very little maneuverability with the government at this current juncture. I think tax revenues have to go up and other receipts have to go up for the government. And already, like even on the other receipts like divestment, we are reaching a level where another a year or two there will be very little flexibility on that side. Then we'll have to really look at a strategic investment and raising money through the other asset monetization. Like government owns so much of land across the country, can that be monetized? Then only government will have more money to help various segments of the economy.
So there's two questions. So one is client is asking for, like, if in the short term, what is a good sector or a particular asset where over the next 6 to 12 months could do better?
I mean, even within this, I don't want to talk about stocks, but look at like autos in last few years. I mean, there's so much of dispersion of return within each sector. Look at financials as a classic example. I mean, look at few of the private sector banks, some of the insurance companies versus rest of the market. There's a lot of divergence in each sector. Structurally, I mean, in India, there are opportunities in every segment. There's a part of consumption which has become quite richly valued. But I mean, consumption is a structural story in India. We are at $2,000 per capita. We will go to 3 and 4 and then 6,000. I mean, there are several industries which are at the cusp of very early stage growth. I mean, they will continue to grow. You need to identify right stocks within each of those sectors.
Since you mentioned auto, the view is where's the auto sector in the next heading to? Is there a serious issue in that?
So it was a big beneficiary of several growth, I would say, tailwinds, including the seventh pay commission. People actually didn't focus as much on that how much it improves the overall spending, including the spending on the durables and autos and all of that. It also benefited from the lower oil prices, and suddenly from a low base, the growth was very good for a couple of years. The margins improved as the input costs remained under control. And now you are seeing, because of whether the BS6 requirement, the costs are going up, the insurance cost has gone up, the fuel cost has gone up, and growth from a very high base has suddenly come off. In fact, talking to auto companies, they are also surprised by the decline in the demand that has happened in last few months, and also now dealers would be now little worried about taking additional inventory, so it will take some time. There are two ways to look at it. One is structurally, I mean, the penetration in India is still very, very low. We have a long way to go. The other way to look at it is there are going to be some of the other disruptions. For example, the move towards the electric vehicles, EVs, and there are going to be clearly few winners and then few losers. We have seen in every industry when it goes through that kind of a disruption, clearly the managements who are ahead of time, they do the right kind of investments, they become the ultimate winner in that segment. I think one should look for those kind of players who are rightly positioned for that.
Uh, what's the view on the INR, given that we've seen positivity from bond yields correcting
Yeah.
a lot of different norms they want from foreign investors, plus the sovereign bond issue, which is a
Yeah.
big positive. So,
Yeah. Yeah.
does the INR look at a good place right now compared to what it was? And given
Yeah.
that RBI is also cutting rates, inflation is
Absolutely,
benign.
yeah, yeah. So on one side, of course, I mean, as I said, that the biggest focus in this budget has been on attracting more foreign savings in the form of FDI, FPI from NRIs and all of that. And even the government itself wants to borrow dollar bonds. That means more foreign flows coming into the country. And looking at the global environment, I think rupees should have an appreciating bias. At the same time, the idea of the central bank and government would be to ensure that it should not reach a level where it starts impacting the export competitiveness of the country, because a cheaper currency, more than the nominal terms, I think in the real terms, will lead to higher imports, and beyond a point all kinds of higher import duties etc won't be able to help us. I mean, if the overall competitiveness is lost, I think we'll pay a price in terms of more imports and less export growth. So government will have to, I mean, the government and RBI put together will have to balance these two objectives, that on one side a lot of money is going to come. My sense is that they will probably sterilize it, maybe they will have to buy in the spot market, but maybe sell in the forward market, which will have implications on the forward premiums going forward. But will ensure that we don't see a huge sudden appreciation in the currency, because you go back in history, every time that happened, it looked good for some time. It is also anti-inflationary. Stronger currency brings down inflation, but it turned out to create other set of problems. Like, I mean, 2013 is a classic case, 2008 is a classic case, and I can go back in history for last 25 years.
So yes, so we've seen announcement of FDI increase in insurance, aviation,
Insurance broking, yeah.
so is there? Do you expect flows to improve, and will this segment start doing better also from a market perspective?
So I mean, that's just one of the factor. I mean, you have to see the each industry is its own the other drivers for the growth, and also I think, several times investors, all of us make a mistake that we extrapolate the industry growth with the stock price returns. I mean, the airline industry has done I mean, wonderfully well in terms of growth for 5 or 6 years, and during that period the largest player filed for bankruptcy. I mean, look at the telecom industry, where we had a phenomenal growth in data consumption in India, and look at the profitability of the sector. And on the contrary, there could be few industries, let's say classic jewelry, where large part of the industry hasn't done well, but within that a large listed player has done so well, barring the last few days, but has done so well in last few years. I think the competitive advantage, there are a lot of other variables which are important to look at, and sometimes just that one single variable, that okay, there is a higher FDI that can come and you should buy the stock, I think one shouldn't do that.
Also, the government's focus has been a lot on housing and all, but if we look at there, is there any, will HFCs get benefited, because they seem to be in a sort of a situation, sticky situation, especially on the fixed income side. Like a lot of as mutual funds also now trying to cut the exposure to this particular segment. So is it a challenge? How can we? Because it's a priority, but we do,
Yeah.
financing is becoming a big issue for these companies.
So two sides. One is that the stronger players are actually benefiting. Those who have a stronger balance sheet, those who have better risk management practices, those who have a more diversified resource profile, including a good mix between the wholesale borrowing and the retail borrowing, etc. And they are going to benefit more because the competitive intensity, at least in the near term, will come down. Banks are also going to be a big beneficiary, and clearly, if you look at every bank result, I think the mortgage growth has been pretty good over the last few years, and I think it's likely to improve further because they have a better liability side, so their pricing power is better from that perspective. So and also I think the new benefits that have been given, particularly for the affordable housing, mortgage as a percentage of GDP is still very small in India, and we have a long way to go. So there is a structural growth in the industry. You need to bet on the right player.
Uh, so this a question which a client has asked is, since you study a lot of global trends as well as global budgets, so if you compare to China, so given this, do you think India has made a good enough case for infrastructure, and should, as a sector, should clients take exposure to infra stocks or infrastructure as a sector?
In China, when they were on the path of infrastructure creation, and that was also driven by, because of China's, the domestic market as a percentage of GDP was not as big. In fact, their focus has always been on an export-led growth for 20, 30 years. I mean, the fixed asset investment as a percentage of GDP was much higher than what we have seen in India, and they focused a lot on infrastructure creation. There was this period of 6 or 7 years when China consumed more cement between, I mean, this,
2003
yeah, the somewhere there in that decade, than what US consumed in last 100 years. That's the magnitude of the investments they made in every infrastructure. And of course, that led to a lot of climate change related issues, and then they had to kind of go slow on that. And of course, the growth has slowed down. So now the country doesn't need that much of fixed asset investment. In case of India, we have a long way to go. Whatever we are creating today is to meet probably not even the demand which is there today. So given 1.3 billion people, I think on every single infrastructure segment, we have a long way to go. The good part is that as an investors, if you think about it, that earlier in the last infrastructure boom, 2003 to 2008 cycle, I think the investors were focusing more on the top line growth, because you thought that as long as companies getting orders, it will result in profitable growth and a higher stock price. And lenders were also more than willing to lend money based on you just get the order book. So you get a 4,000 megawatt UMPP order, and you get money from banks, and you get money from equity investors. Now the sector has seen tremendous challenges in last 10 years. And now both the equity and debt investors are very cautious in giving money to the sector, which will have a positive repercussion in a sense that today every company that we meet, they are a lot more focused on return on capital employed, they are a lot more focused on cash flows, they are a lot more focused on better working capital management. I think some of these discipline got lost out. If you bet on players who have an operating leverage, what I mean that those who have good capacities today, whether in capital goods, engineering, construction, and they have the balance sheet capacity today, that they will be in a position to take larger orders and execute them over the next several years, I think they will benefit. Because a lot of players have moved out of the business simply because, I mean, they had huge challenges on their balance sheet. So from that perspective, lesser number of players, and I think the regulatory environment will only become better simply because we have the past experience. People wouldn't take the risk that no land has been acquired, and then you go and start building the road, and after a few kilometers you realize that my money is completely stuck. So I think people have learned the right lessons, and I think in this cycle, infrastructure related companies, those, I mean, as I mentioned, have operating leverage but not financial leverage, I think they can do well. We feel positive about it.
So also the government has given a lot of soaps for the EV sector, electric vehicles. So do you see that having some scope in the?
These are early days. I think you'll have to wait and watch to play that. I think some of the existing players who are making right kind of investments, I think those could be interesting bets. Yeah, but again, I mean, the move is going to be certain. it's only a pace of that implementation. One can argue whether it's 2025 or 27 or 30. Move towards EVs is a global movement likely to happen in India as well. We have to create a completely new set of infrastructure for that compared to what we have today. And this will again lead to, I think, very interesting opportunities.
So this question is from a client more on given if I have a 3-year view and use mutual funds to my investments, how would you categorize or how would you be which particular segments in equity should I be overweight, fixed income should I be overweight, and in equity and fixed income how much should I where should I put
So each individual is different. I think you'll be a better judge of that, looking at their own, the risk appetite, return expectations, time horizon, liquidity preference, tax considerations, so on and so forth. So each individual is very, very different. But in general, I think if it is more than 3 years, then within the equity, I think a multi-cap where you have an opportunity to play across market caps. We discussed earlier that mid and small caps are cheaper relative to large caps. Maybe the volatility is unlikely to die down in the near term, but structurally 3-5 years that looks a better segment. And fixed income, I think if you have a risk appetite and if the money is for more for 3-5 years, and if you think that the manager has managed this cycle well and have the right kind of risk management practices, I think there is interesting opportunity on the credit risk fund side. The spreads are very attractive. I mean, look at the current yield of the portfolios today. I think at some point in time, with better liquidity and lower rates, as the environment improves, there is a potential for spread compression. So you earn based on a higher current yield, and then you also get spread compression, so you make capital gains on that also.
So on the credit cycle itself, since we were talking of credit risk funds, do you think we are close to the bottom, because the NPAs look like falling quite sharply for even the PSU banks? Those few private banks have shown a little spike, but the PSU overall for the financial system, it's coming down. And with IBC and all, is it more like a classical last stage where we are moving closer to resolution, and maybe if you have as you said, a 3-year, the spreads are pricing in this risk remaining till 3 years, which
Absolutely,
might not be warranted.
Yeah. Which may not be. I mean, we have seen these cycles before. I mean, so you go from, when there is a new boom starts, it goes to a euphoric stage, then you get profit taking, then it goes to a burst, and then people get extremely panicky, and then again a new cycle starts from there, because there is less money which is chasing that asset class. Then the underwriting standards become quite strict or better, but those who come at that stage, they take the advantage of the cycle when it goes to boom and then euphoria. Have we really completely bottomed out? I think we are somewhere there. It's again, I mean, just like I mentioned about the equity market earlier, it's always difficult to pinpoint the exact bottom. But the ILFS crisis happened in September. Now we are in July. It's been like almost 10 months, and it's been a real challenging time on the credit side. Not only the NBFC, HFCs, but several other corporate groups which had leverage at the holding co company level, several of the operating companies, the challenges in the real estate sector and various other sectors. So I think we have gone through a tough time. I think, as I mentioned earlier, with more liquidity infusion into the industry, with more foreign money coming into the country, we're going to see a lot of asset recycling in India, where a lot of these assets where the promoter has got huge amount of leverage will change hands. It has already happened in some of the cases, will happen as well, and then a new cycle will begin. I think over the next few months, if you start taking some risk on that segment, you will be on a risk adjusted basis. I think you'll be rewarded. There's a possibility that you get rewarded fairly.
So these are specifically on alternate funds, because the taxation has made it more cumbersome. Is it that true for the Cat 3, especially long short category? So are these now, because these were generally used as products which could reduce your volatility of your portfolio in this time. So is it better that we take like a multi-asset fund might be a better bit than these in the alternate space?
No, clearly, I mean, a higher tax incidence one needs to take into account when look at the post-tax returns. And from that perspective, some of these multi-asset allocation product or a dynamic asset allocation products relatively have
Have
become
become
more
more
attractive.
attractive.
Yeah.
Also, what's your view on because the government has allowed it in ATC ETFs of CPCs
CPSE.
to CPSE? So should
Again,
should
but
clients
the
be in this
investment
particular
should
sector?
not be, I mean, tax should not become the first criteria for investing. I mean, you have to look at investments on its own considerations from a risk reward perspective, and then, of course, you look at the tax and then the net of that returns. I mean, tax is just one of the
Yeah.
variable,
No,
not
but
the
overall,
sole
the
variable.
PSU sector, do you think that is also because they have been like for nearly 7 8 years, nothing across
Almost 10
sectors,
years, yeah,
they've not.
2009,
So,
yeah.
do you think there is scope there where certain good companies might, and also with the government also saying that they might reduce their stake, which they say in every budget
Yeah,
but
yeah,
don't do it?
yeah, yeah. I think the trigger will be when we see more governance reforms there and we see some of the strategic divestment. As of now, I mean, in last few years, I think one that most of these PSUs are in the core industries. I mean, they are more in the industrial space and let's say in power and those utilities and those kind of sectors which have not done well. The government is not there in IT or consumer companies and all the sectors which have done well for the market. So PSU as a class has underperformed. But if we see more governance reforms, then only we'll see a re-rating of the PSUs purely from a valuation perspective. Surely valuations have come off relative to rest of the market. I think the trigger would be if we see more signs of governance reforms and not only selling more equity into it, but maybe how do they get more focused on generating better shareholder returns.
So we are coming quite close to the end of our 1 hour slot. So we'll take a few last questions. So we've not spoken of healthcare as a sector. That sector has gone through a lot of turmoil.
Yeah.
Is it poised for the next 3 to
So I
5
think
years?
that they had challenges in US where for a couple of years I think both at the volume level Indian companies were growing market share, their pricing power, margins were improving. It was a dream run, and then I mean they had one after other challenges both from the US FDA, from the regulatory process perspective, and also on the competitive intensity and pricing pressure. So I think it was a perfect storm for them, particularly those who are operating in the generic space. And incrementally, there's a lot more competition that's coming from biosimilars and the other segments. What we gather from the companies and from the US market is that I think that pressure on the margins is bottoming out, and we are seeing a lot of companies, actually global companies, pulling out from the generics market because the margins have come off to a level where they don't want to play that. So from that perspective, maybe things are bottoming out. There have been a lot of hopes from the domestic market. All said and done, I mean, with a large population, with a very low per capita GDP expenditure on healthcare, it has a long way to go. India is the diabetes capital of the world. India is going to be capital in most of those lifestyle diseases, and both the chronic and the acute side. There's a lot of opportunities on the domestic side. I think if you have a right player who's focusing on the right opportunities, both global side as well as on the domestic market, some of those companies may start doing well. Yeah. I don't have a macro view on the sector. I think it's completely
Stock specific.
bottom up, stock specific. Yeah, some of our stocks have done well, and we had negative shock on some of our stocks last few years.
So maybe the last question, just to sum up on purely on the budget, since this is on the budget, your 3 top ideas. It can be either segments, sectors, or even like an asset class, and three places where clients should be away in your view.
No, I think very clearly the budget has adhered on the path of fiscal consolidation, which we mentioned earlier, which has opened up space for RBI to cut interest rates, which in turn is good for the fixed income. As the liquidity improves and some of these sector-specific issues get addressed, credit spreads are attractive. I think that can be capitalized on. And from equity market perspective, I think in the very near term, we are going to see higher volatility on account of the growth slowdown in India as well as because of the global reasons. But if you take a 3-5 year view, and particularly in the mid and small cap space, there would be interesting opportunities.
Thank you, Navneet.
Thank you.
We've run out of time, and thank you all for joining and making this quite an interactive webinar. You would be getting a CIP form. We request you to fill that back and give the feedback on this webinar. And in case you have any more queries, our RMs will be happy to address that. Thank you all for joining, and have a good day.